technically, the banking industry is insolvent. And that's a scary thing to say out loud.
Hey guys, welcome back to Library of Wealth. Today we have Morgan Creek Capital's Mark Yusko highlighting the risks facing the banking industry and the need for a massive reconstruction in the managing of bank assets. Yusko notes that JP Morgan recently lost $19 billion in market cap in a single day. This comes on the heels of Silicon Valley Bank losing 75 times more than Silvergate Bank, which peaked at $16 billion, but is currently valued at around $100 million. Yusko believes that the current financial situation is a banking crisis rather than a cryptocurrency problem. He talks about the 2008 financial crisis when Bear Stearns was taken over by JP Morgan, emphasizing the importance of trust in the banking industry. With many banks now struggling with taking on risk, the next few months will be crucial with having adequate liquidity for all customer and investor funds. Let's get right to the latest interview with Mark Yusko. If you enjoy the content we do here, don't forget to hit the like button and subscribe to the channel. Let's get right into the video.
Banking is a very simple business, but it relies on trust. We have to trust that the bank is prudent in making loans, which for the most part, they are. I mean, they actually are, but for the most part. You have to trust that they are prudent in their balance of securities and loans. Something broke down there, though. So when foreign governments rejected the US, for lack of a better term, and there was this alignment of the two axes in the world, and the Chinese stopped buying, and the Russians stopped buying, and Japanese stopped buying treasuries. And at the same time, we decided to increase our spending by handing out stimulus checks et al. Post 2020. What happens? Deficit, massive, trillions, 4 trillion at the peak. Well, if you have 4 trillion of deficit that you have to finance, you have to issue more bonds. If you issue bonds, someone has to buy them. Right? If you're a seller, someone has to buy them. Well, if there's no buyers, what you can do is you can basically mandate that the banks buy your bonds. Now, it just so happens they need to buy these bonds because as the stimmy checks get sent out to individuals and tax cuts go to corporations, they gotta do something with that money, they put it in the bank. Well, when you put money in the bank, it creates demand for either loans or securities, bonds. Problem is, everyone had a lot of money, so they didn't want to borrow any money. So commercial lending activity collapsed. Everybody was locked down. Nobody wanted to borrow money for anything. So, we just happen to have this surfeit of bonds that you can buy. Well, it just so happens that because we're not paying any interest on those bonds, you have this problem. And this is called financial repression. So when a central bank limits the amount of interest by artificially manipulating interest rate markets, you force people to go further out on the risk spectrum. There's going to be a bailout. It's going to happen this weekend. And, I tweeted at Senator Warren and the rest yesterday about, explain to me how JP Morgan lost more yesterday in market cap than Silvergate Bank was ever worth. So Silvergate at the peak was 16 billion. Today it's like 100 million. At the peak, 16 billion. And JP Morgan lost 19 billion yesterday. Silicon Valley Bank lost more, 75 times more than Silvergate did yesterday, and is losing again this morning. So help me understand how this is a crypto problem. This is not a crypto problem. This is a good old-fashioned bank run. This is the scariest chart. This is the scariest chart that might exist. This is a very scary chart.
So Mark, can you kind of walk us through what we're looking at here?
Yeah, so it's basically a long-term chart of the either accumulated gains or losses of the banking system. And what that means essentially, how would you have a gain? Well, a gain would be you bought an asset a bond, and interest rates fell. You have a gain. Or you bought some equity and they went up. And usually banks don't buy a lot of equities, they buy a little bit of equities. They're not supposed to buy a lot of equities, but they did buy some equities. And equity markets were rising. And so on the left-hand side of the chart, you see a lot of yellow, and it's above the zero line. And there's a little bit of downturn, a little bit of fluctuation, but generally speaking, banks aren't supposed to be taking lots of risk in these assets because remember the asset liability mismatch. If your customer can take their money any day, literally any day, intraday, you probably shouldn't lock up the money for 5 years, 10 years, 20 years, unless you do it, as Michael said, in a very diversified way. Like if you lend for mortgages, okay, people aren't going to pay their mortgage back right away. So on the far right side of this chart, you see this cataclysmic, orders of magnitude, 4, 5, 6, 8 times more losses than gains that they're unrealized. And what that means is, as Michael said, as this massive wave of deposits came in 2020, 2021, even into early 2022, all these banks, Silicon Valley Bank, for example, went from 60 billion in assets to 180 billion in assets because there were a lot of companies formed, a lot of new businesses, there were a lot of ICOs, and people got all this money and they had to do something with it, so they put it in the bank. And so couldn't make loans, so what did they do? They bought securities and they bought treasuries and government bonds. On top of it, there was this little problem last year that the Fed started liquidating, because the Fed used to buy all these bonds. If nobody else was there to buy them, the buyer of last resort, the Fed would buy them. Well, then the Fed started QT. So they started selling, particularly these mortgage-backed bonds. And guess who was there to buy them? Because they're government guaranteed. So the banks started buying them. Well, unfortunately, when interest rates go from 0 to 5, you could do math on a zero duration bond. You don't have a lot of loss. 1 year more, 2 year more, 5 year, 10 year. Whew. Now you're talking big numbers. And the problem is these bars on the right-hand side of this chart, basically, if all the banks experienced a run and everyone took their money out, right, to stuff it in the mattress, which is kind of what happened during the global financial crisis, which is kind of why the socks I have on exist, which is all the banks started to fail. Literally, all the banks around the world started to fail, and governments literally had to step in and bail them out and calm the panic. So technically, the banking industry is insolvent. And that's a scary thing to say out loud.
Yusko shows a chart with the accumulated gains or losses of the banking system over the long term. These banks are not supposed to take on a lot of risk assets like bonds or equity, as they need to maintain liquidity to meet customer demands for withdrawals. Yusko also discusses the impact of increasing government spending and the resulting deficit, which has led to a lack of buyers for bonds. To address this, banks may be mandated to buy bonds, which creates financial repression and forces people to take on more risk. Yusko points out the potential insolvency of the banking industry due to unrealized losses. He mentions that as deposits flooded in during 2020 and 2021, banks were unable to make loans and instead invested in securities and government bonds. However, when interest rates started to rise, the banks began to experience significant losses, which exceeded their buffers. Yusko suggests that if a run on the banks were to occur, they would be unable to meet their liabilities, making them insolvent, which is a major concern for the banking industry. What do you think about the latest interview with Mark Yusko and his prediction for the volatile banking industry and where the market is headed next? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.